I'm sure many of you know that gold has just broken out to a new all-time high today, and the mining stocks are starting to perform. But what you'll notice is that this chart here from Incrementum, from Roni Sturfley over at Incrementum, is showing what happens when you reach the last Fed rate hike, which we think we've had here. What normally happens to gold mining stocks, this is using the HUI index, that's the gold bugs index. But look at what happens after the last Fed rate hike. Even as you're going into a recession, gold mining stocks on average tend to perform extremely well. In 0102, we had 76% run up after that last Fed rate hike, 37% in 2008, and then in that 2020 period there, we had a 91% run up, and here we are. I think the Fed is signaling, they've already signaled that it's their last hike for a while, and they may even be decreasing rates again here soon. So this is just another exciting setup for our mining positions. And let's go on to the next. Gold stock funds had their largest inflow in almost a year last week. A lot of people have been complaining how gold is moving up, but for instance, the other funds that U.S. investors and global investors invest in, whether it's the GLD or gold mining funds, just haven't seen the inflows yet. It's mostly been central bank buying that's been driving gold prices higher. But maybe now we're starting to see those flows start to come back. Last week was the first significant week of inflows, the largest inflow into gold funds since May of 2023, in almost a year. So this is encouraging, with gold breaking out to new all-time highs here. Let's go on to the next. So Quentin's going to be talking about our base metal activist metals positions today. And this is a chart we were looking at in our investment meeting the other day. It comes courtesy of Robert Friedland, and it's based on the S&P Market Intelligence data. It's looking at major copper discoveries. And one of the big theses that we have is that there has been an underinvestment in drilling and discovery. That's why we've been focused on getting money to the exploration companies to make discoveries and to do that drilling and create the value that's associated with that. But this macro imbalance of lack of new discoveries at a time when we have all these fiscal spending programs, especially in the U.S., between the Infrastructure Act and the Inflation Reduction Act and the CHIPS Act, we have a number of programs, government spending programs that are bigger relative to GDP than Johnson's Great Society and the New Deal. And all the spending is still on the table yet to come, and we have record deficits that we're going to incur in order to finance the government support of these spending programs. But so there's a major supply and demand imbalance. We don't have the new discoveries of metal to meet the demand for all these infrastructure and renewable energy projects that we have. Look at the lack of copper discoveries over the last 10 years. Quentin's going to be touching on this. Let's go on to the next. Positioning. We are still very much, believe that we have a major rotation coming, a rotation out of overvalued, long duration financial assets and into undervalued commodities. And in a rising commodity price environment, there's opportunity on the long commodity equity investing side of things. And investors are overweight, not just in equities and large cap growth equities and mega cap tech in particular, but also in bonds. Interest rates have come up. The Fed raised interest rates. We had a big bond market correction investors lost money in bonds significantly, you know, in the last year as interest rates have come up. But what have they done? They've just bought more bonds. The issue with government debts and deficits is that somebody's got to buy that somebody's got to buy those issuances, and it's become more attractive in a higher rate environment for investors, even though they've been burned by being long duration treasury bonds. They've come back for more, and so investors at large, money managers, this is the BofA Fund Manager Survey, are the most overweight in bonds relative to commodities that they've been since the bottom of the market in December of 2008. And look at this is part of our great rotation idea. It's why in our global macro fund, we have short exposure to long duration government bonds. We have a yield curve steepening trade. We're long the 2-year yield, duration matched, and we're short the 30-year. And we also believe that money will be rotating out of overvalued mega cap technology stocks and into undervalued commodities and commodity related stocks. This is just showing the positioning, how unbalanced it is. And we think this portends a lot of upside appreciation potential ahead because of the undervaluation of commodities relative to the overvaluation of bonds. Let's look at the next chart. This is my last one. I just wanted to reiterate this chart. We showed this about a month ago, but this is looking at just showing in another way that we have record valuations for large cap growth stocks, large cap S&P 500 companies, valuations that are at historic highs that match other markets like 1929 and like the tech bubble, higher than the tech bubble valuations in terms of market cap concentration among the top decile of stocks, the top 10% stocks. This data comes from Deutsche Bank, and it's showing that same kind of market cap concentration and overvaluation. We've shown the overvaluation in many ways. This is showing the concentration that goes along with that overvaluation at major critical market moments, and we think we're at one of those today. We believe we have a great rotation coming out of large cap equities, overvalued mega cap growth stocks in particular, and mega cap tech especially, and into undervalued commodities and commodity stocks. In our global macro and our long short funds, we're positioned to profit from both sides of that rotation out of overvalued large cap equities and into undervalued commodities. We're long undervalued commodity equities through this activist metals portfolio that we've created with Quentin. We also have other commodity exposures on the equity side in oil and gas, and we have a small biotech portfolio too, where we have an expert similar to Quentin, PhD, industry expert on the biotech side, who's been helping us pick the early stage biotech companies that were so beat up in the last couple of years that many of them were trading below their cash in the bank. But our largest long exposure across the firm is on our activist metals portfolio. And the opportunity on the short side, however, is also there, as we believe money is going to rotate out of overvalued long duration assets. In our global macro fund, we're expressing that through a yield curve steepening trade in addition to our shorts and overvalued mega cap equities. And in our long short fund, we're more focused on the equity side of that trade. We don't have the yield curve steepener. We believe so much of this trade is ripe to play out. For those interested in just the long only activist metals side, we have the precious metals fund. And that, like I said, that is also the largest long sleeve of our other two funds. I think it's one of the most opportunistic times to be investing in this great rotation idea. There's so much ready to unfold. There's so much deep value on the long side of the undervalued commodity markets that are getting ready to break out under rising inflation and a Fed that's ready to start lowering interest rates again here pretty soon. But inflation is not going away. Inflation is sticky. So if you're interested in our strategies, I really encourage you to reach out to American and learn more. I just think it's a great time to be putting money to work with gold breaking out. With stocks like Apple starting to roll over, they're not even talking about the Mag 7 anymore. It's the Mag 5, right? Because Apple has rolled over. Tesla is down substantially. I mean, so look, the time is here. I really believe it's time to take a serious look at Crescat Strategies. We've had a pullback, but now we're starting to see positive performance come back, inflows coming into the mining sector. It's just a very exciting time, we think, to be putting money to work